Good morning, everyone. Welcome to Capstone Coffee Conversation. My name is Ryan Skokstead. My partner, Brian Felshaw, was going to join me this morning, but he came down with a little flu bug. So he is sitting today out. So you get me all by myself. Thanks for being here. We are recording this meeting. We post these meetings, just so you know, if you ever wanted to look at past meetings or other content, we post these Capstone Coffee Conversations to our YouTube channel, which is Capstone Wealth Advisors. So if you just go to YouTube, search Capstone Wealth Advisors, you can pull us up. You'll see our emblem or symbol. And yeah, you can look at past conversations if you'd like to. They're kind of all archived there. Today, we are talking about Federal Reserve, interest rate increases, potential where we're going from here, and some of the opportunities or pitfalls that creates in the bond market. So we'll be talking about that today. If you have any questions, hit the chat button on your Zoom, and Moesha is back here, and she will read those at the end. So just hit a message to host and type in a question, and we'll cover it at the end if we can. Okay, so this year has been very challenging for the bond market, and it's been a very challenging year overall. Right? It goes without being said by this time. And a lot of times people will call, and I'll get clients to say, boy, this is awful. The stock market is crazy. Get me out of stocks, or how can we stop the bleeding? The stock market's awful. Honestly, this year, the stock market isn't that awful. The stock market's down. Yes, it's down close to 20%, depending on the day you look at it. It's been a little bit worse. It's been a little bit better, but around 20%. To date on the year, that's not setting any records, right? So obviously it doesn't feel good when the stock market's down 20. We still have a month and a half to go, and we're in the midst of a nice little rally right now over the last 5 weeks. But the stock market being down, mid-teens to 20%, somewhat expected after the last handful of years that we've had for a positive return. So the stock market, I would say, is behaving. We don't like it when it's down, but it is behaving. There is nothing outlandish. Stock market is pricing in a slowing, a potential recession, but probably a mild recession. That is kind of what the stock market is pricing in. Slowdown in economy, maybe a mild recession, not to be unexpected after, the positive years that we've had. The difficulty this year is not the stock market, although it's down. The bond market is not behaving. That has been the biggest challenge for the year. Just to put it in context, and I've shared this stat with you, or with a lot of clients, over the last 50 plus years, the worst bond year was 1994 during the savings and loan crisis. And if you look at the bond market index, the bond market index was down 3% in 1994. That was the worst year for bonds in the last 50 plus years, right? So that's why bonds get kind of the medallion of safety. When the worst year is a -3 in 50 years, that's a pretty safe investment. This year, at the bottom, bond market was down 17%. So over the last 50 years, the worst year is down 3. This year, it's down about 6 times the worst bond market year in 50 years. That is statistically, obviously it's not impossible, but that statistically stretches the realm of possibility. And so the bond market is the biggest challenge of the year and is not behaving, right? And so that's been, it's been somewhat expected, but the extremeness of the difficulty this year was not expected. Rates at 1% to start this year. We were kind of avoiding your traditional bonds, trying to do other things to have some safe investments and make a little bit of money, but rates have drawn up drastically and very quickly, and that's been the challenge for the bond market. So when you have the worst year by 6-fold in the worst 50 years, does that create opportunities, right? Just like if you said, well, the stock market's down 6 times the amount it's ever been down in 50 years, that should, to investors, create the idea that that's an opportunity, right? So is that an opportunity? Well, today, we kind of think there are some opportunities. Okay, doesn't mean that we're calling the best time in the bond market today, not necessarily, right? There could always become a better opportunity in a month or 3 months, but that does create opportunities. And so I'll kind of go through a list of some of the opportunities now in the bond market. Today, we can earn about 4%, 3.9 on a 3-month cash-like fund. So this is a fund that invests in very short-term positions, 3-month in duration. In other words, as long as you kind of didn't need the money in a week or even 11 weeks, but if you said, I probably won't use it for a few months or longer, but you want to have it very liquid, very flexible, we're earning about 4% on that type of investment today, right? So that's it has been well over a decade since we could say that, right? You see your savings account opportunities or even CDs, CD opportunities at the bank have risen, right? But a CD, you have to lock your money up, maybe 3 months, 6 months, a year. This type of investment, again, liquid, you can take it out at any time. You don't have to keep it there for 3 months, but we would probably recommend if you didn't plan on it that you don't do it. But as long as you had a 3-month and potentially longer duration, it is completely liquid at any time and earning about 4% today. So that's an opportunity and something very cash-like. If you're able to kind of have a little bit longer than a cash liquid anytime fund, but have a little bit of a duration, today in corporate bonds, and bonds, when I say corporates, I mean things like Verizon, Bank of America, Goldman Sachs, Boeing, et cetera, right? Companies that are very stable. I can't see, hopefully, in the next 1 to 5 years, those having any solvency problems. Nothing's ever off the table, but very stable companies have been around for a long time. A 1 to 5 year duration for those types of fixed income pieces is currently paying 5.5%. Right, so that is very, again, something we haven't seen in over 2 decades, basically, is kind of the late 90s, since we saw bonds of that nature at that short of a term paying 5.5%. Treasuries, 2-year treasuries paying 4.75%. So again, as long as the United States government is still operating in 2 years, buying a treasury today, 4.75% 2 years from now would be your annualized return for those 2 years, right? Lastly, going out and extending your duration doesn't really help much. The short end, the cash, almost the cash, or the 2 to 5 year, 1 to 5 year corporates, or the 2-year treasury is actually paying more than a 10-year bond. 10-year treasuries today are paying about 4.1, 4.2, depending on the day, right? So the 2-year treasury is 4.75. The 10-year treasury is about 4.2. What that means is we expect rates at some point in the short term to start coming down again soon. And who knows when? But that's kind of what that means. Is the economy is predicting somewhat of a recession, call it mid to next year, and rates are going to have to come down on the short end. All right. So that's some of the opportunity, though. Having a treasury, be it a 2-year or a 10-year, 4 to 5%, depending on your timeline. We haven't seen that for over a decade, 15 years. The corporate bond paying about 5.5. It's been about 20 years since we've been able to see that in cash right now, paying about 4% for a 3-month type of fund. So those are some of the opportunities. So you've heard us kind of in this volatile stock period, moving some types of funds to very short-term, high quality, some corporates, types of fixed income, because we're getting paid for that again, right? The risk of that is inflation is at 8.3, I believe was the last reading. Might have been 8.1. It's a little bit, it's in the low 8s. We have another reading coming out the end of this week. Predictions are somewhere in the 7s for inflation. So if you're signing up, the risk is if you're signing up for a bond that is between 4.75, 5.5, somewhere in that neighborhood. Well, if inflation's running at 7 or 8, you're actually signing up for a bond that's losing a guaranteed 2 or 3, right? And so that's the risk, is if inflation doesn't come down quickly, we're actually going backwards relative to inflation, right? When inflation 5-10 years ago was running at 1 and 2, nobody was signing up for bonds that paid -1, right? A known -1. So that's kind of the same thing. If you're signing up for a bond that pays 5, but if inflation's running at 7, you're signing up for -2. Okay, so that is the risk, is that if inflation stays high and doesn't start to creep itself down, having a bond, even though 5.5 sounds good, you're losing 1.5 to 2.5 to inflation if it stays at 7.5, right? So that is the risk. We kind of see inflation having having peaked, starting to come down. How fast is anybody's best guess? But we do see it starting to tick down. I think the Fed has been raising rates dramatically. That is starting to do some damage in the economy. That will most likely start to be felt in the next few months. And so inflation, we think, has peaked, but hopefully can come down to more normalized levels quickly. So some of these bonds like 4 3/4 and 5.5 can actually be a meaningful return rather than just trying to keep pace with inflation. So where is the future direction? Number one, when people say, I hear this comment a lot, well, the Fed's going to raise rates, so interest rates are going to go up. And that is false. The Fed can raise the short end of the curve, but it has no bearing on what the long end of the curve might do. And I'll give you just a simple example. If the Fed says, we're going to raise basis points, we're going to raise interest rates 50 basis points next month, okay? We go for the next month, 30 days, what have you. If the Fed did exactly what it said, rates would not move, right? If things happen exactly as expected, the markets don't move. The markets move when things work differently than expected. Nice. Give you another, like the stock market. Let's say we all bought stocks yesterday, and today the news media they turned on the news this morning and they said there's no news to report. We have no earnings, no wars, no political news. We have no news. How many buyers and sellers would there be in the stock market? Would the stock market go up? Would it go down? It'd probably just stay flat. My guess, nobody would do anything, right? There's no news, no positives, no negatives. The market would stay flat. The stock market and the bond market don't trade on the news. They trade on expectations and how the reality is different than the expectations. So our expectation right now is the Fed will probably start to slow down interest rate increases, but has probably 2 more hikes to go. And that's kind of the normal expectation. So 50 basis points in December, and maybe another 25 basis points in January, and most likely done at that point. And if that plays out, we think interest rates will stay about the same, right? Inflation will start to come down, interest rates will stay about the same, and that would mean buying bonds, the 4 3/4, 5.5 is a decent deal at this time. The risk, inflation stays high, maybe the Fed has to keep raising rates above expectations, then we would have wanted to hold off on buying those bonds. Or the way that would work out really in our favor if you're buying bonds now would be inflation comes down pretty quickly and the Fed doesn't have to raise rates as much. Then bonds would really rally. But if things go as normal, we think you're getting a pretty darn good return now for some short-term, intermediate-term fixed income. We would say, like always, just like with stocks, don't push all your chips to the middle thinking you know what's going to happen. We've been selectively buying on a consistent basis as rates have been going up. They've kind of plateaued a little bit now as we're starting to get more of a consistent picture from the Fed and starting to understand exactly what they're going to do, and their reality is matching expectations. That wasn't happening 6 months ago, right? So, but buying on a consistent basis throughout market environments really spreads out your risk. It allows you to buy at different times and kind of reevaluate as we go. So a dollar cost averaging into fixed income. If you have cash on the sidelines and you're thinking, hey, I'd like to earn 4 3/4, 5.5 on short-term fixed income. Well, we would say, let's do it in pieces over a few months or a couple quarters of a time period. One last opportunity I'm going to talk about before we turn it over to questions. So if you have any, make sure you submit those. There's becoming a proliferation of private investment, and that's on the stock and the bond side. The public markets are shrinking since the year 2000, right? The Wilshire, for instance, the Wilshire 5000 was created to have 5,000 stocks in it. Today, the Wilshire 5,000 has about 3,200 stocks. The public markets are shrinking. The private markets are growing. Case in point, there are about 100 times private stock mid-sized companies as there are public stock mid-sized companies to invest in. So we are starting to, at Capstone, we're looking more and more at having access for clients to private equity type of funds or private credit bond type of funds. Pros and cons, obviously, to all. Negatives would be we give up a little liquidity. Sometimes it's monthly liquidity, sometimes it's quarterly liquidity, but it's not daily liquidity. Okay? Another con is sometimes they can be a little more expensive. They are privately held, they're not as easily accessible. But the pros, we feel, can really outweigh the cons in the fact that some of the private credit funds that are out there, fixed income, paying about 8%, 9% for some high quality private bond type of investments. That has really shot up over the last year, as everything else has as well. But having access to those private credit funds, if you're able to set aside 5%, 7% of assets and say, I'm not going to need this. I don't need daily liquidity. I'm okay with monthly or quarterly liquidity on this fund. That will be something we begin to introduce to our clients as that is becoming much more palatable there and much more easily accessible for our investors. So be watching for that. That is all that I had prepared. And so I'm going to ask Moesha now, are there questions from anybody?
So with the rise of interest rates, do you see a housing crash like we did in the 2008 recession?
Okay, thank you. Interest rates have risen dramatically, and mortgages mortgage interest rates have risen dramatically as well. And so this has put a real slowdown or damper on housing prices, right? We were seeing auctions for homes. You put your house up for sale and you could sit back and kind of wait and just, highest bidder type of mentality. That has dried up, and we're actually seeing now price reductions in housing. Okay? The one thing that the 2008 crisis caused was a severe supply issue in housing. Builders quit building in the financial crisis for 5-10 years. So we still have a housing shortage. And now with rates going up, that also affects builders. That affects new apartment buildings. That affects, the single family residence developments. So yes, you're having buyers shrink back a little bit, but you're also having builders shrink back, which when that happens, the supply demand stays in a constant, in kind of a continual state. So we're not going to see just a huge supply where builders keep building and buyers go away because of mortgage rates, and that's going to cause a housing crash. So that's one reason is there's not a huge supply that will cause a crash demand wise because the builders are going to stop building also. Secondly, people have equity in their homes today. People are financially solvent. People still have their jobs. This has not been a job-led recession yet. So could it have we've already seen some downturn in housing. Yes, we're not going to see the price increases that we've seen the last few years, much like the stock market. Housing saw a dramatic increase, very normal to see a plateau, somewhat of a pullback. But as long as the supply doesn't exponentially grow while the demand stays low, then the crisis of 2008 2008 was very different than hopefully what we see here. And so far, that's how it's setting up to play. Any other questions? I'm getting the thumbs up. So with that, I'd like to thank you again for being here for Capstone Coffee Conversation, and stay tuned for next month and we'll come and see you again. Thank you.